Okay, good evening once again. In the absence of no distraction and no interruption of the internet, we can actually start the class now. I hope you guys enjoyed our last class where we talked about the concept of adjusted profits, where we talked about again the difference between the taxable profits and the non-taxable profits, where we explain the concept of accounting profits, where we explain the concept of accounting profits and taxable profits, where we said again that an accounting profit is a profit derived as a result of the fact that you've used the concept of accounting principle in ascertaining your profit. You have used the concept of IFRS. You have used the concept of international accounting standards to determine your profit. However, we now said again that this situation will warrant that the profit that we're going to be charging will be different from the profit that we are going to be charging if we had used the concepts in our tax. And that is why we need to reconcile the accounting profits back to the taxable profits. So I told you we have what we call the allowable expenses and non-allowable expenses, where I said allowable expenses are the expenses that are wholly exclusive, reasonable, and necessary for the purpose of generating taxable income. Having said this, we move on straight to types of examples of allowable expenses, examples of non-allowable expenses, examples of taxable income, and example of non-taxable income. We discussed all those in our last class, and I understand, and I hope that every one of us in this class will understand the concepts very clearly. If that is the case, we move on to the next topic for today. Our topic for today is the capital allowance. When you talk about capital allowance, one of the expenses that we usually disallow in our profit and loss account is the depreciation when we are trying to ascertain our assessable profits. Depreciation is one of the expenses that we usually disallow. And the reason for disallowing depreciation, I have told you severally that when you look at depreciation, for example, depreciation has various methods of calculation, which makes it inconsistent, which also makes it for the tax authority to, we makes it difficult for the tax authority to assess the taxpayers with tax as and when due, because you will not be, the tax authority will not be able to compare various taxpayers that have acquired the same asset on the same date and put into production use on the same dates, based on the fact that these taxpayers, because there is no accounting standard that restricts them from the adoption of any accounting method, there are no regulations that also restricts them from using any accounting method. They could use any accounting method, they could use any accounting rates. That means this is not becoming too much of inconsistency from the part of the taxpayer. Therefore, the tax authority deems it fit to introduce a more reasonable approach to which a company can use to recover the cost incurred on assets. You remember, when you talk about depreciation, for example, depreciation is just the spread of the historical cost of the assets over its estimated useful life. Therefore, what we are now trying to say here is that for an expenditure to be recognized in taxation, I told you last week that the taxpayer must have incurred the expenditure. So, but when you look at depreciation, for example, the taxpayer is just spreading the cost of the asset over its estimated useful life. And in taxation, we don't give regard to provisions. Having said that, when you have not disallowed capital allowance, sorry, depreciation, for example, that means, again, the problem still persists. To solve the problem of depreciation being disallowed, capital allowance was introduced. What is capital allowance? Capital allowance is an allowance granted by the tax authority to the taxpayer that has incurred qualifying capital expenditure. You can also say capital allowance and allowance claimable in lieu of depreciation charge in the income statement. That means the tax capital allowance is an allowance granted in lieu of depreciation. By implication, instead of charging capital allowance, charging depreciation rather in the income statement, capital allowance will be granted to the taxpayer. Okay, let me give you a scenario. In this scenario, assume a company had acquired the same assets and put them into production use at the same date. Let us also assume that the cost of the assets is 10,000. The two companies have acquired the same assets for 10,000 and have also put it into production use at the same date. Let us also assume that the accounting rate of this company is both 10%. 10%, 10% for company A, 10% for company B. Let us also assume that the method of depreciation is straight line method for company A, reducing balance method for company B. With that, if we apply the principle in our accounting to calculate depreciation on a straight line method, it is going to be on costs. To calculate depreciation on reducing balance method, it is going to be on book value. What is your book value? Book value is total cost minus accumulated depreciation. I'll say it again. Book value is the total cost minus accumulated depreciation. By the time we apply this, for example, in the first year, both taxpayer, that is the taxpayer that has adopted straight line method and the one that has adopted reducing balance method, will be charging the same amount of depreciation for that first year. But as time goes on, in the second year, the taxpayer that is using the straight line method will be charging 10,000, while the one that is using reducing balance method will charge 9,000. You remember, we said it is on accumulated depreciation, that is cost minus accumulated depreciation for reducing balance method. In the third year, the taxpayer that is using straight line method will charge 10,000 again. Meanwhile, the taxpayer that is using reducing balance method will charge 8,001. When you look at that, for example, you will notice that this taxpayer had acquired the same asset and put in the production use at the same dates, but unfortunately, these taxpayers are charging different amount of depreciation. That is one of the reasons why capital allowance was introduced, to fight against or to reduce or remove any form of irregularities, to remove every form of inconsistency in application and in methods. Okay. Now, I have given you a brief background of capital allowance. And when you say capital allowance, now I believe that everybody in this class understand what capital allowance is. So we have said that capital allowance is the allowance granted in lieu of depreciation. Capital allowance is an allowance granted to a taxpayer that has incurred qualifying capital expenditure and put same into production use at the end of the basis period. Now, basically, there are three methods of capital allowance. There are three ways in which we can get our capital allowance. There are three ways we can get our capital allowance. The first one is the initial allowance. Okay, the first one is initial allowance. The second one is the annual allowance, and the third one is the balancing charge. We might not really call balancing charge a type of capital allowance because balancing charge arises from disposal of qualifying capital expenditure. Before now, we used to have what we call investment allowance. However, with effect from 2023 Finance Act, taxpayer will no longer enjoy what we call investment allowance. Reasons for disregarding depreciation in taxation. I have explained this because it lacks uniformity both in method and application. There is no uniformity. So then this means that we have to disallow the cost. But again, we need to now replicate it or replace it with something, and that is capital allowance. So one of the reasons why we disregard depreciation is because of the problem of lack of uniformity. The next one is that it does not involve numerical cash because it's just an estimation, a spread of the cost over its estimated useful life. The next one, there are no accounting standard which requires all the taxpayer to use the same method and rates. Therefore, it's a very big challenge for tax authority to be able to place the taxpayer, different taxpayer that has incurred qualifying capital expenditure and put them into production use on the same date, on the same pedestal. You cannot actually compare taxpayer, and this does not make sense. So that is us. So I have been able to paint that scenario that I talked about the other time in this place. For example, assume company A and B acquire the same assets, and these assets were put into production use on the same dates. It is possible that this taxpayer will be charging different depreciation and will also be charging different, we should also be applying different method, which will make our depreciation to be different. And therefore, it brings about what we call inconsistency and problem of this uniformity. I have defined what capital allowance is the other time. I said capital allowance is an allowance granted to all taxpayer who has incurred qualifying capital expenditure during the basis period in respect of an asset in use for the purpose of trade or business at the end of the basis period. So that is that. Now, what are the features of capital allowance? We said number one is calculated using standardized statutory rates. The method of application is uniform and consistent to all taxpayer. Equal amount of money will be claimed by different taxpayer, provided the assets were acquired and put into production use at the same period, and the costs are the same. The same set of rules apply to all taxpayers. That is, now, what capital allowance has done is to eliminate different rules to all taxpayers. That means, by implication, the same set of rules shall be applicable to all the taxpayers. Benefit of claiming capital allowance. What are the benefits to the taxpayer now? It brings about immediate tax/cash benefits. Why? Because it will reduce your taxable profits. The next one, it reduces or completely shelter a tax liability. The same thing as what number one. And number two is that it improves cash flow and keep cash in your business, in the business of the taxpayer. Do you understand me? You know, the amount that you're supposed to pay now, you are not paying it. I mean, that means your cash flow, you can use that amount that you have or that you have gained as your cash, as your capital allowance you can use it back in your business. Okay, you can use it back in your business. Therefore, we say it remove cash flow and keep cash in the taxpayer business, in the taxpayers business. Another advantage is that there is possible refund or repayment of tax to the taxpayer. The amount saved as cash capital allowance can be plunged back to the business, isn't it? So the amount saved as capital allowance can be plunged back into the business. You can plunge it back into the business. And we also said that the capital allowance makes it possible for cash refund or repayment of tax. Now, take for example, when a company ceases operation, the Act says that the taxpayer has rights to carry backward the capital allowance for a maximum period of 5 years, okay, against the profit. That is the tax they have paid before. You can recover it. That is the essence. That's an opportunity that capital allowance presents to the taxpayer. Now, what are the conditions for claiming or for granting capital allowance? These are the conditions that the tax authority look at before the taxpayers are granted capital allowance. Number one is that expenditure must be incurred on the asset by the owner. That is, the person making the claim must have incurred expenditure. You don't just say, I want to claim capital allowance without incurring expenditure. You must have incurred expenditure. The next one is that the person / company claiming the allowances must be the owner. You can see that I underline that. Must be the owner of the assets in question. So you can't claim where you didn't sow rather. So that means if you are claiming your capital allowance, you must be the one that own that asset. The assets must belong to you. Why are we trying to check this ownership of the assets? Because we don't want two people to be claiming capital allowance on the same assets. And therefore, capital allowance shall be granted only to the owner of the asset. The next one is the qualifying capital expenditure must be in use at the end of the business period. So you must always, at every point in time, make use of these assets. You must use the assets. So you must use the assets. Any temporary disuse, if you are no longer using the assets, such will not qualify for qualifying capital expenditure. You will not qualify for capital allowance. So you must use the asset. Now, another important thing that is very important, that is very essential for us to note is that the assets in question must be owned by the person. We have said that, and the asset in question must be used for the purpose of generating taxable income. We said it must be used for the purpose of generating taxable income. So that is that. The next one is that the capital allowance, for example, must be for, before you claim as the capital allowance, the taxpayer must have incurred an asset or qualifying capital expenditure that is more than 500,000 and must obtain an acceptance certificate from the Ministry of Trade, Investments, Ministry of Industry, Trade, and Investment. And the most important thing there is that an application must be forwarded by the taxpayer to the tax authority. This area that I'm reading to you or that we are looking at now, our examiner might not really ask you this area. Now, what are the conditions for granting capital allowance? So they might not really ask, but it is good that you know it. Now, let's go to what we mean by, I've been talking about qualifying capital expenditures. So let's look at what a qualifying capital expenditure means. What does it mean? What does it mean? Before we go ahead, I would want you to ask me any question before we move to the next part. Any question? Today I want to see everybody's face. So if you are not properly dressed, you can please. I want to see everybody that I've been teaching. So later, before the end of the class, you share your picture. Let me see your face, so that when I see you outside, I will know my students. I know a couple of you, but not every one of you that I know. Okay, so that is us. Let's go. Do you have any question for me? Do you have any question? Okay, in the absence of no question, we'll move on to the next one. Okay. What is qualifying capital expenditure? I could also make you look at qualifying capital expenditure as the same as the assets in question. Qualifying capital expenditure is the same thing as the fixed assets of the company. Okay. And these are also the asset that qualifies again for capital allowance. So that means it is not all the assets that qualifies for granting of capital allowance on them. And there are some assets that policy of the company might also restrict from including them as part of the asset. Take, for example, a company, we said all assets of the company, all are qualifying capital expenditure, but there are some exemptions. Now, take, for example, a company that had acquired stapler. Stapler is supposed to be an asset, right? When you look at it very well, stapler is going to last when you look at the characteristics or what will be by capital expenditure. We say capital expenditure has the character of extending beyond 1 year, right? Which is the same thing as stapler. Your stapler can extend beyond 1 year. Do you understand me? So we're now saying that company policy might say stapler, write it off to P&L. This might be because maybe the company just look at it that this value is minute, so they will just write it off to P&L. So they can just say it's for, they can just act as part of stationaries, but we know that it might be more than that. So let's look at some reasons for excluding some assets from capital allowance claim. Unlimited nature of the useful life of an asset is an example of this. An asset that does not have useful life will not qualify for capital allowance. An asset that does not have what? Useful life will not qualify for capital allowance. So example of this is land. Because when you are talking about our qualifying capital expenditure, the Act specifically says that building, you can claim allowance on building, annual allowance on building for a maximum period of 10 years. Land usually goes beyond 10 years. So because of its unlimited nature, it is going to be exempted from granting capital allowance on such. Now, a student will say, Mr. Christopher, Mr. Chris, how many times did I call you? I will say you have called me 3 times, right? So I will now say, your question will now be, what about if the examiner, under examination condition, gives us land and building? Where you see land and building, just categorize it as building and apply the same principle that you usually apply for building for it. So let's go. The next one, some assets can be subject to specific legislation. This restricts or exclude them from qualifying capital due to activities. For example, building used for residential purpose. You cannot claim capital allowance on building used for residential purpose. You remember, one of the characteristics or condition for granting capital allowance the other time was the fact that I told you that the assets must be used for the purpose of generating taxable income. Let me show you that. Purpose. Purpose is very important. Look at it. The qualifying capital expenditure must be used for the purpose of generating taxable income. So if an asset is used for private purposes, such will not be allowed to enjoy capital allowance. That is what we are saying. We move on to the next one. We move on to the next one. Such assets used for non-business purposes are also exempted. If it is used for non-business purposes, are exempted. Company policy, I've explained that. Perforators, staplers, I've used that as an example. So that is that. So when you're talking about qualifying capital expenditure, I said qualifying capital expenditure are expenditure incurred for the purpose of any income and qualifies for the grant of capital allowance. So that's that. Now, what are the examples of qualifying capital expenditure? Most likely also, examiner will not be asking you for this because I believe it's too much a request for examiner to ask. So, but examiner can ask you that you should list types of qualifying capital expenditure. So we have qualifying building. Building is divided into 2. We have the industrial building and non-industrial building. So I'm still going to share this material with you after the class so that I can go through it. We have qualifying agricultural expenditure. You have qualifying agricultural expenditure. You have qualifying mining expenditure. You have qualifying plant expenditure. We have qualifying plantation expenditure. We have qualifying research and development. We have qualifying public transportation. We have qualifying public transportation, new mass transit coach of 25 seats and above. You have qualifying capital expenditure on development or acquisition of software or other capital outlay on electronic application. So those are the types of qualifying capital expenditure. Now, just like I said before now, all assets of the company, except if they have one reason or the other that I've explained another time that will not make us charge capital allowance on it, are qualifying capital expenditure. So we can now move on to the next one, which is types of capital allowance. Now, basically, you remember the last time I told you the third one that I mentioned at the introductory aspect of this class will arise as a result of the disposal of the fixed assets. So if it is not disposed, balancing allowance. If the asset is not disposed, balancing allowance is not relevant. So if I've said that, we can now move on to the next one, which is basically we have 2 types of capital allowance. Before now, it used to be 3, which is investment allowance was part of it. Investment allowance was part of it, but now investment allowance has been taken out from the equation. So the first one is initial allowance. What is an initial allowance? This class stops by 10 o'clock today, so bear with me. I'm very, very tired, and I hope I'll be able to do more class with you, but unfortunately today I'm very tired. But no issue, we extend it till 10 o'clock by the grace of God. But I want to hear you guys' voice. I've not heard your voice today, and I'm not comfortable with that. Can you say hello to the teacher?
Hello, sir. Good evening, sir.
Hello, Prof.
So I can Aramide's voice and what was his name? Prof.
Hello.
Fine.
Hello, good evening, sir.
Okay, believe. Good evening.
Hello, sir. Fidel.
Good evening.
Good evening, sir.
Godwin.
Yes, sir.
Godwin, good evening. Godwin, you are a female?
Female.
Okay,
Female.
Judith. All right, Judith, your
Yes,
voice.
sir. Good evening.
Good evening. Otumba Balek. Okay, at least I've heard some of your voices. That. You can mute your mic now. Let's move on.
Good evening, sir.
Yes, I greet you, Otumba. Well done. All right, let's go ahead. You can mute your mic now. Okay. So I said basically we have two types of allowances, which is the initial allowance and the annual allowance. What is an initial allowance? An initial allowance is allowance granted to the taxpayer that has incurred qualifying capital expenditure once throughout the useful life of the assets. So we are saying that this type of allowance is granted only once throughout the useful life of the assets, and it's granted en bloc. That is, it is not prorated. It is granted in full. You don't prorate this type of allowance. Now, let's look at some basic treatments of initial allowance. Treatment of initial allowance where assets is transferred related party transaction. So the amount of initial allowance should be made in respect of the expenditure shall be the amounts as the relevant tax authority may determine to be just and reasonable, having regard to a circumstances relating to the asset and control. So it is a tax authority that will determine the initial allowance if it is between related parties. Okay. Well, we have the characteristics of initial allowance here. I said it's granted only in the first year of use of the assets. It is calculated on the agreed cost of the assets. We also said it is granted once in the useful life of the assets. It is granted in full, irrespective of the number of months in the basis period. Irrespective of the number of months in the basis period, initial allowance is granted in full. Initial allowance is granted in full. So it does not matter when the asset is acquired, provided the asset falls within our basis period, the initial allowance should be granted in full in that particular year. Any unabsorbed capital allowance, that is initial allowance now, can be carried forward indefinitely. You don't need to restrict it. We'll move on to the next one. An annual allowance. What is an annual allowance? This is the allowance granted on all qualifying capital expenditure throughout the useful life of the assets. That is, till the end of the life of the assets, you are going to be granting annual allowance. There are characteristics of that, which is it is granted throughout the useful life of the asset. It is calculated using the straight line method. It is prorated to the number of months in the basis period of the relevant tax year. So we are saying for the number of months in which the asset is going to be used for, you are going to prorate it. So that means this one is not granted in full. It is prorated to the number of months within the basis period. The next one is that it takes into consideration in determining, it is taken into consideration in the determination of the tax received value. When you are calculating your tax received value, your tax received value is equal to your cost minus initial allowance minus annual allowance. It is cost minus initial allowance minus annual allowance. That is how to determine your tax received value. Any unabsorbed capital allowance here can be carried forward indefinitely, where it may not be claimed in full, where the asset is not acquired at arm's length. So what does that mean? That is, if it is not acquired in an open market transaction, then it should not be allowed. So let's look at how to calculate annual allowance. This is where the issue starts. In calculating annual allowance, where there is no abnormality in the first year or when the business is ongoing. So what we are saying here is that if there is no abnormality in the basis period, your capital allowance shall be the cost price minus the initial allowance divided by the number of years. Divided by the number of years. So that is your costs minus initial allowance that I have calculated divided by number of years. In this situation, we use this formula. Are you writing down, Sha? We use this formula where there is no, where the basis period is not less than 12 months. That is when we use this formula. If the basis period is less than 12 months, you will not be able to use this formula. Where the basis period is less than 12 months, basically, whether because the assets has been disposed or because the company did not commence business on 1st of January, or the company commenced business midway, or the company ceased operation, then you use this formula. That is cost minus initial allowance divided by N. N is number of years, multiplied by Y. Y there is the number of months in which the asset is used within the base period. And 12, you know, 12 is 12 months. How do you calculate? How do you calculate your N? How do you calculate N? N is calculated as 100% divided by annual allowance rate. Examiner, under examination condition, shall give you annual allowance rate. Examiner shall provide rates. Let me show you something. Under examination condition, examiner shall provide you with this table where you're going to pick the rates from. We have the initial allowance rate and the annual allowance rate. Let us assume that a company acquire motor vehicle. Your rate for motor vehicle shall be annual allowance 25%, initial allowance 50%. So let us assume that the cost of the asset when we bought it for 100,000. To calculate my annual allowance, initial allowance is 50% of the cost, which shall be 50% multiplied by 100,000. That would be 50,000, right? Now, for us to now calculate our annual allowance, our annual allowance shall be your cost, which is 100,000. I'm coming. Shall be the cost. Should be the cost 100,000 minus 50,000 divided by 4. How did I get 4? 4, you remember we said initial allowance, the annual allowance shall be the cost minus initial allowance divided by N. And our N is 100% divided by annual allowance rate. The annual allowance rate for this question, we said, is 25%. Therefore, 100 divided by 25 will be what? 4 years. So the asset will use 4 years. So I'm going to have my cost, which is 100,000 minus my initial allowance, which is 50,000 divided by 4. Whatever answer I get is my answer. The next one is, let us assume that the number of months this asset will use is less than 12 months. If that is the case, let's assume a company was just acquired, just commenced operation. Let's assume they commenced 1/4, that is 1st of April 2020. And the accounting date of the company, let's say, is 31st December. That means the assets, the company will only enjoy it for 8 months. So I will say 8/12 multiply 8/12 8/12 multiply by whatever you have here. That is your annual allowance. Why did we use 8/12? Because the number of months in our basis period is less than 12 months. Then we have to prorate our annual allowance. Any question? So I've defined the notes. N is the number of years the asset is here to use, and you know how to calculate N. X is the number of months, number of years already used.
Excuse me, sir.
Go ahead.
From the illustration you have made for the capital allowance, 1st April to 31st December is 9 months and not
Okay.
8.
Thank you for that. 9/12 multiplied by whatsoever that we have. Thank you. All right. So we can now see. Now, I also have another method in which I use to calculate my annual allowance. But the reason why I also put this method is because examiner at times are funny. But in the recent time, in the last 4 or 5 years that the examiner has been testing annual allowance, they've only used this method. They don't use this method. So we'll only be doing this method that the examiner uses under examination condition. To calculate your annual allowance, where the number of months is not less than 12 months, shall be your cost minus initial allowance divided by number of years. So now, residue value or tagging down value. Now, an asset acquired by the company can last up to the end of useful life. Can last up to the end of useful life. After which, the asset is expected, the taxpayer is expected to retain 10 naira. The taxpayer is expected to retain how much? 10 naira. Taxpayer will retain 10 naira from the asset disposal. Taxpayer will retain 10 naira. So what we are trying to say is that at every point in time, when you have exhausted the useful life of the assets, you cannot write off your assets completely away from your book. So in the last year of use, the taxpayer must retain a residue. And that residue is the same thing as the taxing down value in the last year of use. And the taxing down value in the last year of use, or in the last year in which the useful life of the asset has been exhausted, must be equal to 10 naira. So you must remain 10 naira. That is the law. So, and that is the reason for this formula. We are going to be interpreting the formula as we go ahead. Just like I told you the other time, I said initial allowance, investment allowance has been taken away by the effect of 2023 Finance Act. So we are not going to be talking about that. So this is the table. I've said the other time. I'm still going to share this with you, no issues. Now, for today, we are going to go back to our basis period for capital allowance. We have done basis period before, but this is also another dimension to basis period. So for capital allowance, if you acquire an asset, there's every possibility that you will not know where the assets will be introduced. So basis period for capital allowance is the enabler, is what will help us identify the year and the period we can introduce an asset that we have acquired for the purpose of claiming capital allowance, that is both initial allowance and annual allowance. Let's go. Look at this, for example, illustration 1. Jessica Ventures, sole trader, commenced business on 1/4/2025 for 2015 and prepares its account to 30/6 annually. Now, during commencement of trade, most of the time too, when an asset is acquired, okay, during commencement rule will be applicable. Commencement rule will be applicable. And what is our commencement rule? I have told you, when a company commences operations, 3 years are going to be statutory. That is the one the law talked about specifically, are 3 years. We said the first year will be assessed to tax from the date of commencement to 31st December of every year, of that year rather. Sorry, from date of commencement to the end of the first accounting year end. That is in the first year of commencement. In the second year of commencement, it shall be a day immediately after the end of the first accounting year end to the end of the second accounting year end. The third year, for example, will be a day immediately after the end of the third accounting year end to the end of the third accounting year end. That is a day immediately after the end of the second accounting year end to the end of the third accounting year end. We have explained this before. So we want to now bring it into capital allowance. We said an asset was acquired. These are the assets. The company commenced operation 1/4/2015 and prepares account to 30/6 annually. So these are the qualifying capital expenditure. This is the cost. These are the costs. These are the date of acquisition. So the examiner says you should determine, how do you assess qualifying capital expenditure acquired prior to the date of commencement? If you are writing, you need to write this down. Any assets acquired prior to the date of commencement shall be deemed to have been acquired on the date of commencement. I'll say it again. Any assets acquired prior to the date of commencement shall be deemed to have been acquired only on the date of commencement. So that is that. So these assets, the first asset, motor vehicle, was acquired 1/2/2015. Remember, the company commenced 1/4/2015 rather. So that means any assets that you acquired before these dates, shall be deemed to have been acquired on these dates. So this one that was acquired 1/2/2015 shall be deemed to have been acquired on 1/4/2015. So that is that. So the first thing that you are going to do, the examiner also said you should prepare your asset allocation schedule. So the first thing that you are going to do is to prepare your asset allocation schedule using the applicable rule. The applicable rule here is this company is a commencing business. Therefore, you have to apply the commencement rule. So, in the first year of commencement, this company commenced 1/4/2015, Abi, and don't forget the accounting year of this company is 30/6 annually. So it's going to be 1/4/2015 to the end of the first accounting year, which is 30/6/2015. In 2017, it will be 1/7, that is a day immediately after the end of the first accounting year. So what is the day immediately after this one? It is 1/7/2015 to 30/6/2016. The next one is a day immediately after the end of this one, which should be 1/7/16 to 30/6/17. And fourth and subsequent years should be on preceding year basis. We have done that. So you now go back to the question. We want to see how to allocate the assets to the relevant year of assessment. Also note that in this question or in this era that we find ourselves now, there is no overlapping of basis period. Therefore, no assets will find it difficult to be able to allocate to where it was acquired. So how do you allocate assets? You look at the dates. This asset was acquired before the date of commencement. We have said it's going to be assumed that we have acquired on the date of commencement. So these are commencement dates. So any asset acquired before the date of commencement will be assumed that it has been acquired on the date of commencement. Therefore, motor vehicle was acquired on that date. The next one. Plant and machinery was acquired 1/10/2015. We'll come back to our basis period. Can we find 1/10/2015 here? No. Can we find 1/10/2015 here? Yes. Abi, that means plant and machinery would have fallen within this period. The next one is furniture and fitting. It was acquired 10/8/2016. We'll come again. Can we find 10/8/2016 here? No. But we can find 10/8/2000 10/8/2016. We will find it here. Can you see? 10/8/2016 is within this period. So we'll find it here. Now, note, capital allowance and depreciation are not the same. In your depreciation, when you want to calculate the annual allowance, your depreciation, you would have said because this asset was not acquired, look at the dates, was not acquired at the beginning of the accounting period, we are going to prorate it. No, you are not going to prorate the annual allowance yet. Why? Because the number of basis period is 12 months. So when we want to calculate our annual allowance for this year, it is going to be a full annual allowance. Why? Because the base period here is 12 months. When we want to calculate our annual allowance in this first year, the basis period is not up to 12 months. Therefore, we are going to prorate our annual allowance. Do you understand me? So we move. This is it. This is the calculation. Now, just like I told you, examiner will give you this rate. No, what's it called? You don't need to cram it. So in the first year of use, we acquire motor vehicle. Abi, motor vehicle we acquire for 1 million. So initial allowance rate was 25%. 25% of 1 million will give you 250,000. Now the next one is annual allowance. You remember, because the number of months in this base period is not up to 12 months, we are going to prorate the annual allowance. How do we do that? Look at it. We say cost minus initial allowance divided by n multiplied by y/x. When you look at it. This is 1 million minus 250,000 divided by 5. How did we get 5? How did we get 5? We got 5 from the annual allowance rates. Our annual allowance rate is 520%. So if I say 100 divided by 20, we have 5 years. Abi?
Yes.
Good. So to get my annual allowance, I will say cost minus initial allowance divided by number of years the assets we enjoy. So that is 5 years. That's how I got to this number. So I bring it in here. So you remember, again, I told you a tax nominal value is the total cost minus initial allowance minus annual allowance itself. Therefore, our tax nominal value will be our carry forward value to the next tax year, which is 712,500. Now, in this second year, if you go back to our allocation table, you will notice that we acquire motor vehicle, plant and machinery. We acquire plant and machinery. How much do we acquire the plant and machinery? We acquire for 1.6. The same thing, you calculate initial allowance, 20% of the cost. Ma'am, annual allowance to be calculated here shall be 12 months. We are not going to prorate it. Why? Because the basis period we have here is equal to 12 months. You are not going to prorate it. Sorry, this place is equal to 12 months. And when you look at this place, the base period we have here is less than 12 months. But here, the base period is equal to 12 months. So you are not going to prorate the annual allowance. So we have costs. 1.6 minus 3.2 divided by 5. We get our number. Now, in the second year of use of these assets of motor vehicle, we have the tax value of this. Now that the base period is now up to 12 months, we need to calculate the right annual allowance for these assets. So how do we do that? That is 1 million minus 250,000 divided by 5 will give you 150. So we did not prorate it now. Why? Because the number of months in this various period is what is in this various period rather is 12 months. So you are not going to prorate the annual allowance. You also calculate the annual allowance for plant and machinery. You get your answer. The next one that you'll do is to also get your tax nominal value. But before tax nominal value, we acquire additional assets. On that new asset that we acquire, we must calculate initial allowance and annual allowance, fully annual allowance, and so on and so forth. So, annual allowance is constant. When you look at this, constant. Abi? But this has gone into the last year of use of these assets. Of our motor vehicle, these are our last year of use. So in the last year of use, your annual allowance will be equal to your tax nominal value less 10 naira. So your annual allowance here will be equal to your tax nominal value that you've gotten and less 10 naira. That's what we did here. Less 10 naira. So we've done that. Because in the last year, just like I told you, you must retain something in your books, which is the 10 naira. You must retain something in your book, which is the 10 naira. Any question before we go ahead? Any question? Any question?
So just the way of your curiosity, why retaining 10 naira in the books?
Okay, because yes, go ahead. Yeah. The reason for retaining 10 naira is that when this asset is eventually disposed, we must have a value that we are going to use to compare with our sales value. Do you understand me? Because we also need to calculate whether they make profits or they make loss on disposal. And that is when balancing charge and balancing allowance will come into play. That's where balancing charge and balancing allowance will come into play. Any other question?
Yes, sir.
Go ahead. Go ahead with your question. We cannot hear you. Is anybody hearing her?
No, sir, we can hear her.
Okay. In case you still have this question that you want to ask, send me a WhatsApp chat. I will respond to you.
Okay, sir.
All right. Or if you still have the question now, you can ask me. But if you don't have the question now,
I have the
we cannot hear you again. Okay, send me a chat. I will respond to you on WhatsApp. So let's stop it there for now. I'm going to send you this material tomorrow so that before we come to the next class, we would have been able to review it ourselves. Capital allowance is going to take us for the next 2 weeks to complete. So that is that. I think we should round up this class now. Good day to you if you don't have any question.
Good day, sir. Thank you for the lectures.
All right.
Thank you so much.
You're welcome.
Thank you, sir.
Yeah, thanks, guys. Good night.
Good night.